Welcome, 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 everyone. Thank you so much for being here. We are so excited to have Jason Williams. If you are an active investor and you are looking to raise capital, you might want to listen closely to what Jason has to say. So I am at the shore, which I don't usually go to, although I live on the West Coast, which is the beach. And so I picked this for me instead of for Jason. No offense, Jason, but it's Play in the Waves. Life is better with sandy feet. Surfing's one of the few sports that you look ahead to see what's behind. And I love this from Buddha. In the end, only three things matter: how much you loved, how gently you lived, how gracefully you let go of things not meant for you. So this is really wonderful. And I'm letting go of all the stress I've had for the last few months because I'm here at the shore. And I would like to introduce Jason. He has a remarkable background. Jason Williams' journey into real estate investing began in 2003, though his roots in the industry stretch back even further. As the founder of the Ironclad Underwriting Mastery Program, co-founder of the Academy Presents, and managing partner of Lauren Capital LLC, he's made significant strides in the field. Jason's expertise spans diverse asset types, from single-family home rentals to large multifamily apartment syndications, making him a go-to authority in the field. And Jason's story doesn't start there. After graduating from Texas Tech University with a BS and a PhD in chemical engineering in 2002 and 2006, respectively, Jason's academic prowess is matched only by his practical experience. With over 15 years career in engineering, he honed his program and system development skills, ensuring efficiency and accuracy in his work and bringing a fresh perspective to real estate investing. Now fully committed to real estate investing, Jason seamlessly integrates his engineering background into multifamily real estate ventures, particularly through his renowned underwriting program, Ironclad Underwriting Mastery. Tune in as Jason shares his insights, strategies, and the secrets behind his underwriting mastery, making complex concepts accessible and actionable for listeners eager to dive into the world of real estate. Oh, we love real estate, Jason. So thank you for being here, and please take it away.
Thank you, Peggy. I'm going to share my screen if I
Okay.
can.
Hi, Jay. Glad to have you here.
So there we go. Can y'all see my screen?
Yes.
Yeah, I'm Jason Williams. That bio is still kind of foreign to me. Yeah, it's me, but it just sounds weird listening to it. Um, so bear with me. But yeah, I appreciate being invited here to speak on underwriting. I do have an underwriting mastery course. This is my logo. It's the boat, which is an ironclad. And so, really, who am I? Other than what Peggy just read off, I am Jason Williams. I have a PhD in chemical engineering, and I've been in industry for 15 plus years as an engineer, but I've been investing in real estate for 20 plus years. And I switched to full-time real estate back in July of 2022. So I'm right at the 2 year mark that I'm now a full-time real estate investor. And I have worked and trained with numerous high performers, including Joe Fairless and Trevor McGregor. If you're not familiar with who they are, I recommend looking them up. And what I do is, as an engineer, I would develop systems for like the salespeople and other engineers for what my job is, an R&D engineer. And so I had to basically make systems and models foolproof for them. And so I took that and put it into my underwriting for multifamily acquisitions. Um, I've been developing my model. Actually, it's for the last 6+ years. Um, I've gotten a hold of a lot of different models, either by purchasing courses or people bringing underwriting to me so that I could help them with it. And so I grabbed all the good parts of each model I could find and I put it into my own model. So now I have a very robust, accurate um, model that can handle all sorts of different situations. And I have also created models for different asset classes, for different syndicators and operators, such as RV parks, mobile home communities, self storage, even hotels. So if you want to create a foundation of concrete, or if or do you want to create a foundation on sand? So if you want to create a foundation on concrete, you should listen to this. If you want to create it on sand, you should go and celebrate the 4th of July early, and we can talk to you at a later date when you want to switch over to concrete. So
They can join me at the shore.
so imagine if what your portfolio looked like every time you sat down and ran numbers, if you knew that your deal was is worth it, if you knew that when you submitted an LOI, you knew that the numbers you ran were backed with third party verification, and so you can submit those LOIs with confidence. And whenever you are raising capital, if you could answer the hard questions from investors and lenders, that they always ask, that um, they're hard, but whenever you do your underwriting right, you can answer those quote unquote hard questions with authority and confidence. So if you do that, then um, yeah. So if you can do that, imagine this, then this presentation is for you, and if needed, we can carry it further. Um, Also, I know there's a lot of gurus out there who have very simplistic Excel sheets that they themselves do not use. So, whenever you do have millions of dollars at stake, do you want to use some simplistic spreadsheet that you got for $150 online, or do you want something that's robust and sound and know that whatever you put in, it's going to give you accurate results? So, just imagine, if you will. So with that, I'm going to go into the 7 red flags of underwriting that I have personally seen. I have another program that I do called Second Set of Eyes, where I help people with their existing underwriting, and or I would be their underwriter for them whenever they have a deal. So a lot of people, they get deals and they run it through a simplistic program, but they don't really know if it's good or not. And so I help them determine if their assumptions are good or realistic. And so that's the 7 red flags are what I see whenever I go through those. So the first red flag is trusting but not verifying. So this is going to be coming from, like, whenever you talk with a broker or a seller, they are trying to sell something, right? It doesn't matter if it's a good deal or not. They just want to get it sold so that they can get their commission and move on and sell something else. And so I've seen countless times where underwriters are using information directly from like a OM, and they're not using any third party. So that's the first red flag, is make sure that the underwriting you're looking at or doing yourself, you are using third party verification. The second red flag is using temporary trends for the long game. So we are definitely in a different time than when we were 3 or 4 years ago. Um, I know some of y'all have heard how San Antonio and Phoenix were growing 4 years ago in 2020, 2021. And so they had double digit rent growth back then. And so people were underwriting with 30% rent growth in San Antonio. I've seen numerous deals from San Antonio come across my desk saying, hey, we're going to get 30% rent growth because that's what it's doing. Well, guess what? Now they're actually having rent decreases in both Phoenix and San Antonio because it got oversaturated. Things aren't going as planned. And so now you're kind of hosed, especially if you buy a property expecting 30% rent growth. You're going to be over your head, and you're probably going to be giving this property away to the mortgage company or something like that, or tax, or the county whenever you can't pay taxes because you can't afford the rents the way you thought you could. The third red flag is arbitrarily following a guru. Now, I'm not saying all gurus are bad. And this sort of goes out to the trust but verify. Um, there's every guru has good and bad deals. You need to be able to vet them. You need to be able to know if your guru that you're following has actual deals in it and they're actually practicing what they're preaching, or if they're just trying to sell you a program and the only interest they have at heart is padding their own pocketbook. So, um, I've seen numerous times where someone would bring me underwriting and they would say, "Well, so and so told me I can expect this," or "So and so told me I can expect that." So this one also sort of goes along um with yeah, trusting and verifying, but just like blindly following information from like a broker or like from a guru who don't necessarily know the market, but they're just saying, yeah, you can assume this and do that. So I have actually helped people numerous times get out of situations where they could have been really bad for them, just by arbitrarily following a guru. Um, Number four is blindly putting numbers into a model. So just about every guru out there has a model you can use. And you can pay extra if you want to watch the video on how to fill the model out properly. But most of the time, whenever I get a deal or underwriting from somebody, I look at it and I'm like, do you realize what you're doing here? You're like triple dipping on your rent increases. And they're like, no, I'm not. Yeah, I followed what the model told me to do. It's like, well, no, you didn't, because you increased it here, and then you also increased it here on the back end that you didn't remember doing, and so you actually are triple dipping, and so they don't know how to fill out a model. Um, they don't know what all the cells mean or what, so they might go in with like a rent roll and say, well, this is the average rent roll or whatever. This is the from the T12. This is what taxes are. So I'm going to put it here. It's like, well, what kind of taxes are they? And so it really matters if you put the cell or the values into the right um value into the right cell. So that's yeah. So a lot of times when I see this, it's like, what were you thinking? Or they don't know any better. They're doing the best they can. And so I help them straighten it all out. When I do help somebody, I actually go into each cell, find the equation, and I make sure that it's looking at the values it's supposed to be. It's like a choose your own adventure book where I click on a cell and go to tab so and so, go to cell 045, and that refers you back to another tab. And so I do that whenever I help somebody with their underwriting, because a lot of times they don't know what it is, and that gets confusing if you don't know what to look for. So um number five, this one is a big one, and a lot of people will argue against me, but considering only annual cash flow, I consider monthly cash flow, because with monthly cash flow, I can get annual cash flow. I just add up all the 12 months. But with annual, you can assume something's right. You can say, all right, well, so for this property, I'm going to be making $18,000 in cash flow after debt service. Okay. So when you do that, you divide it by 12, you're estimating about 1,500 per month in cash flow. But that's not how business is actually run. What you're actually missing is in the first 6 months, you might be negative and have to go out of pocket or into your reserves $12,000. And then you make it up for it in the latter half of the year whenever you start getting the renovations done and everything else, and you can start bringing things up to market value. And then you might be 24 or 18, 36,000 in the latter half of the year. But when you add in the 12, that's when you get the 18 or whatever, 34,000 to, I can't do math right now. But what you see is you would be coming out of your pocket for time, and you have to be able to be prepared for that. And a lot of times people don't recognize that until it's too late. And you might be thinking, well, it only matters in year one. It's like, well, no, it doesn't matter just in year one, because if you have an interest only period on your loan, you might be experiencing it once the interest only period runs out and you're actually paying principal and interest. Your debt service is going to be increased. Or if you do a refi and you take out more equity than the cash flow can handle, you might be negative in that regard too. So whenever you can model that and look into that, that's when you can alter your business plan to affect how things work versus just blindly doing numbers, doing the annuals, and then hoping everything works out for the best. So this is a big red flag that I've seen. Number 6 is not stress testing. The biggest thing I've always seen is everybody underwrites conservatively. But what does that mean? If you underwrite conservatively, you're never going to get a deal. It's just it, because you can't. Everybody has risk tolerances, and you can underwrite to less risk tolerance. But everything is a risk in investing. Something bad can happen, and do you go into those worst case scenarios, and do you look and see what kind of returns you'll get whenever occupancy drops down into 70%? Or do you look at what happens if your cap rate on exit is 3 points or 2 points higher than what you were expecting? Cap rates are going up, and if you're not stress testing, you're not doing these scenarios, then you're just asking for trouble. If you're doing an investment and you're expecting the best case scenario for this investment to work, you're just asking for trouble. So be sure to stress test, look for the worst case scenarios. Worst case, I mean, granted, worst case might be um, occupancy drops to zero for some reason. If you get hit by a tornado, you should have insurance that should at least bail you out. But if you can't make your debt service or you can't pay your taxes, you're going to get foreclosed on and you're going to lose everything. And that is actually happening right now. It's happening day after day. It started about April of 20, was it 22, when 23, when things started going south for everything, and now they're just falling down like dominoes. So you got to really try to really do the stress testing. um and number 7, I meet a lot of people who wanted to get into investing, and they're like, all right, so what markets are you investing in? It's like, well, I'm investing in DFW. I'm investing in Raleigh and South Carolina and Charleston. I'm investing in Alabama and Florida. It's like, well, which one are you investing? I want to invest in all of them. It's like, well, until you know everything there is to know about your market, you're not going to be able to do very well. You need to concentrate on a single market, know everything there is to know about it, know how many apartment complexes are there, know who the owners of the complexes are there, know who the brokers who sell in that market are, get on their list, and you need to walk properties, tour them. Even if you have no intention of submitting an LOI, at least tour a property and meet with a broker, learn who they are, learn who the owners are. Learning who the owners are is going to be a little bit more complicated until you're in it for a while. But then you start seeing pitch decks of people saying, well, I'm buying this in Raleigh and we just closed. So every time you see one of those that says close and it's in your market, find out who the owner is who just bought it. And that's a good way to get in. And another thing is if you're in a single market and a lot of your properties are there, then you get economies of scale with your property management, you get economies of scale with expenses. And so there's a lot of benefit to concentrating on a single market before you move on to a second one. Um, so learn one market very well and then move on to the next one. So, and then I actually have an extra red flag to look out for is I know a lot of people who are in this, they're going to YouTube University and they do some underwriting videos. I think they can handle it. And then they're out in the wild and you're like, well, who's teaching you how to do this? Or how did you find out this information? It's like, well, I found it on YouTube. It's like, so that's another red flag for me is a lot of this comes from experience. And if you can change your experience, you can turn decades into to months. If you use a teacher or a mentor, that will really help with yours. So I'm just throwing that out there, partly because I am quote unquote a guru and I do have a coaching program for underwriting, but I'm not expecting y'all to sign up with me. I'm just giving you some red flags that I look out for. So that was pretty short and sweet.
Good.
If y'all
Yep.
have any questions.
That was great. Yeah, I have several questions, and I'm sure a few other questions will come up. I know when you brought up the conservative, the underwrite, what I have found when I'm vetting out somebody's deal, they're vetting because they're experienced. Their vetting is not conservative, but when they put out the executive plan to the investor, the limited investor, they make that more conservative so that they actually it helps them look better, but they want to make sure that they've put everything in place. And just in case something doesn't go like it's supposed to go, they're covered by being what they call conservative. So they say they're going to do whatever their return is going to be, but they do expect it to be higher because their underwriting shows that it really ought to turn out to be higher. So
Yeah.
I really like that you brought that up because that's super important. But
So
I do have a question.
I have seen that where they will and now nowadays people are actually giving ranges for return metrics. It's like IRR anywhere from 14 to 16 and a half or 17%. It's like, well, which one is it? It's like, well, we stress tested at this and then this, and we think it'll fall somewhere in between. So there are some people doing that, and it is becoming more common to see ranges of returns versus 3 4 years ago where you're like IRR 18% or 21% or something like that. So
I mean, they're not
some of
putting the
them, oh,
yeah, they're not putting the deal together, so it's profitable. That's what that tells me.
yeah.
Can you stop sharing your screen so we can have people raise their
Oh,
hand?
sorry. Yep.
No,
Sorry.
that's all right. It's great. Thank you very much, Jason. This was wonderful. I do have a couple other questions. So anybody who's got questions, raise your hand, please, with the little thing,
So
raise hand on the bottom.
David Simon had one. How would you mitigate a situation and stress test it? You want to come off mute and be more specific on what you're asking?
Yeah, hi, can you hear me okay?
Yeah,
Yes, I
David,
can.
yeah,
Yeah,
welcome.
yeah, hi, hey Peggy. Yeah, you mentioned stress test. I just wanted to kind of just go through that and your thoughts of that and the best way to do that.
So my model, I have sensitivity analyses where I can check different ranges of exit caps. I check different ranges of stabilized occupancy or how long it takes to get stabilized. In my model, I can also go in and do different scenarios of different things, like what would it take to do a refi in month 3 versus 4, or year 3 or versus 4, or whatever. So my model can handle it. Other models that I have seen are not very good at it. you can go in and like create a second model and rename it and run different completely scenarios. But did you have any things you wanted, like specific, a situation you're wondering about?
No, I was just confirming or, asking the question based on that and your analysis.
Okay. Yeah, my model can do some, and a lot of times if it can't, I will change it so that it can. So
Okay. I have another question, and this had to do with I can't remember what it had to do with one of your flags. So cap rates, to me, cap rates are really important. So how do you, when you were looking at what the returns are going to be, so a cap rate against the interest rates, do you look at it that way?
um I have looked at it that way, and I know you want to have cap rates higher than your interest rates. But it
Yeah, by
really
2 points.
it all depends on what kind of deal you're doing. If it's like a heavy value add, versus like a turnkey, there's all sorts of different investment criteria that I don't blanket saying this is what it should be,
Mm,
because there's so many different business plans where you might be buying a property at a cap rate of 2.6 in a 5.25 market, but you know that going in because occupancy is horrible. And so you're going in and you're revamping the whole thing, and you're going to turn that property around so that even though the cap rate is so low, it's because the current occupancy has so low. And so the NOI is really low for the price point. And so there's a lot of different nuances that you're going to look into, that I can't just give blanket statements like that. And it depends on the experience of the operator. If you're going in and you've done like new construction and you're planning on doing everything again, then go for it. If you're coming in off the street and you want to buy a new property, then I would probably say that that property is not for you, because it's more advanced and requires more work than you know what to do with it. So
So if it requires a lot of work, that means that the current owner didn't maintain it or take care of it. So I am
mhm,
going to deduct that amount off of my offer
right.
because they didn't take care of the price. Now, if I'm going to upgrade, I could see that would be capital that I need to add in. But just to bring the property back up to where it's decent, that comes off the top of the offer. We're not going to pay, we make our profit going in. So if
Yeah, that's
I,
what I'm
I mean, I
saying.
would never buy something at a two. I would expect that if the place were 80% vacant, there's some real problems. I still want my 8 and 10% cap rate. Why would I offer less?
I'm not saying that's bad. And like I said, everybody's different. Everyone has different experiences. And so some people are comfortable paying a little bit more. It could be like a high,
If
um,
you're
high,
protecting
high,
you have your job as a syndicator is to protect your investors. If you overpay for a property, you're not protecting your investors.
I understand that. And I tell people, I'm like saying, hey, this is what you're looking at if you're looking at a 2 point something cap. And they say they understand that. I was like, all right, I'm just letting you know, so long as you understand it and you have the wherewithal to handle that property, and maybe it's in a highly desired area where there's a lot of competition. And I'm not saying there's a lot of competition nowadays versus what it was 4 years ago, but
Mhm.
some places do still have a lot of competition. And so, and this goes back to, there is no conservative underwriting.
Yeah.
It's all about risk tolerance and what you're willing to risk, because the riskier you are, the more deals you're going to get. But that also means the more likelihood of things going south for you if you don't know how to run the property right. So
Right. I really like your comment about concentrating in one area. for a syndicator, because those that are moving all over, they are at higher risk. And I also wanted to let you know that LA is also experiencing a rent decline.
Yeah. I honestly, I don't even think of California whenever I invest because I want nothing to do with it. So I know people invest there, people make money there, but that's not my cup of tea. There's too many laws against landlords that I don't even think about it as an investment.
Understood, but I live in California, so how could I not think about California? And my sister is a property manager for 40 units, so I'm usually up on what's going on and with LA rent control and with cap rates and with whatever's going on. It's just, yeah.
Yeah. No, no, I understand. And I have a lot of friends in California and most of them don't invest in California, to
Yes,
be
neither
honest.
do I. I don't invest in California either. Sorry, you can't give me the good cap rates. I
Yeah.
want my good cap rates.
Yeah.
And I want that growth. You just have to do longer term holds in California. And
Yeah.
how could you have a better place to live? What can I say? Does anybody have any other questions? Hello, Bill Gross. Welcome. We're excited you're here.
Thanks. Yeah, I have a
for
2
coming.
o'clock that competes with this, but finished up early today, so I'd jump in and get some good wisdom here.
Yes, well, Jason's an underwriter, and with what you do in your Jason, Bill works in the probate world. So they work with people that have properties for sale, and many times I would think you have to underwrite what that condition of that property is.
I know Jason and his wife. I will say that as an investor, I also invest outside California for long-term holds. I do some flips here because I'm in the business and I see good deals, but I wouldn't hold a property for more than a few months. If it's any kind of, it requires a permit, I'm not in. I'm going to find a customer for it and sell it. I am a broker, so that's my primary business. So I'm quick to do that. But I actually have one I'm in escrow in where it's really a long-term flip, where I locked in the price 6 months ago, and it may not close for the year, which is great because I get depreciation, but I haven't had to write a check to own the property. I haven't had to manage the property even. So, but yeah, I'm with you. But I will say, Jason and Peggy, I've met people who invest successfully in LA, and two things are true about them. One is the ones who do that are that's all they do, and they have every angle and they have every detail and every system, and they work that like nothing else. Number one, makes sense. Tough place to do business. You better know what you're doing. And two, I know that every month I hear of another one of those people leaving LA. So, I have a good friend who's here local, huge investor, Henry Menasheri, but who's no longer buying in LA and now selling. So, it's one of those things where even those who know what they're doing and have done well for years, some of them are getting a little too over the head here in LA.
Well, thank you, Bill, very much for that. Yeah, and that just shows being an expert in the area is so important. And then when they move, they go be an expert in wherever they've moved to, because they'll keep doing whatever they were doing. But
Yep.
that's what I found about real estate people. Just because they move doesn't mean they're stopping their real estate investing. Does anyone else have any other questions or comments for Jason? Let's see if I had any more questions. Actually, you covered so well. Oh, here's a comment that I had. The second set of eyes. You have brought up that it sounds like you meet a lot of first-time syndicators, or they're just doing their own deals. That second set of eyes is so important because there's so many things, even if you're experienced, that you might not see, or that somehow you skipped it, or you just didn't see it on the list, or you were looking for it and then you got distracted and you missed it. Having a second set of eyes on your underwriting so very, very important, I think. So
Yes, I agree.
for sure.
And my own underwriting that I do for my own deals, I always send it to somebody else on my team to go over, make sure that I didn't miss anything, or make sure that one of my cells that I was not an artifact from a previous property we looked at before. So, I mean, easy things to miss, especially in a big, complicated model. So it's always good to have a second set of eyes. So everybody should have it, no matter how experienced you are. Because like you said, you might miss something, or you get called away and you come back and you forget what you were doing. And so you pick up where you think you left off. So
Exactly. Does anyone have any other questions or comments? Well, I think that wraps it up for us.
Well, this is David. I had a quick question, Peggy.
Oh, good, David.
I had a question reference to income. So verifying income, a lot of times the sellers, there's, it has pro forma numbers or not necessarily the right numbers as far as rents and so forth. How does your system go about in locating and making sure that's accurate?
So during your due diligence period, you should be asking for bank statements so that you can see what the deposits are into the account. And if you don't get those, then you probably know something is up. And that's how I would verify that. If you have a reputable property manager who has a reputable like property management software, from my experience, if you have those two things, then the verification is pretty much done for you. But I would always go back and double check with bank statements. And you can request that in your PSA and put it in your LOI so that they know ahead of time they need to provide them. So,
David,
then,
don't you usually ask for a rent roll?
oh yeah, no, absolutely. Absolutely. But what I'm saying is if the rent roll comes in and there's missing information, missing numbers, even with the bank statements, maybe there's some, I don't know, the accounting wasn't done properly kind of thing. That's what I'm saying. Also, I had a question. You mentioned management companies. And if you find a deal with the management company's not doing quite a good job as well, how that transition, to finding find somebody to do that, and then maybe finding some of the flaws, in that system as well.
so my experience with property managers is usually, unless it's like just some small company, if it's like a large company that has like markets all over the nation or like a region of the nation, and the property management is not doing well, it's usually just like the regional in that area. And so they should have correct records, even though the regional is not doing what they're supposed to. That would be one way, but you should always interview management companies that are in the area or willing to come to the area if or when you acquire a unit. And then once you get a feel for them, then you can start moving forward with it. The thing with management companies is it's not like a GP member where you're married to them for 5 years. You can hire and fire management companies. I've done it before. If you work with them for 6 months and they're not acting up, then you go in and you need to start saying, all right, we need to either change something or we're finding somebody else. So.
And then a third question I have in reference to the, you're looking at this offer and they're not really telling you about the area, or maybe you got some people in your community that are, are creating some problems and issues. There's been some bad stuff going on and you don't know about that. What are some of the good ways to find out more of the details in that?
There's a website, and what is it? It's crimemapping.com. You can punch in a zip code or an address, and it'll give you an idea of the latest crime in your area. You should also, before I submit any LOI on a property, I have either walked it myself or I have a team member walk it, take lots of pictures of the neighborhood so that you know what you're getting into and you don't just do something blind. If it's important enough to invest in, it's important enough for you to go spend a day or two at the property, even if it's a plane trip away or something. So I recommend doing that for sure. And then while you're there, you can talk to the local police department and see what's going on in that area, because they're more than willing to help you. A lot of times police have somewhere to live too, so they might be actually have a policeman on your property. So
And
then
is
that
that a
will
good
help too.
sign? Have a
So
policeman on your property? Not always, sometimes.
yeah, so I've walked the property, and one of the people on my team talked to the police, and they're like, yeah, well, we just had someone murdered here 2 weeks ago. So I was like, okay, thanks
Good
for
to
that.
know. Yeah. So one of the
Is-
things I always did when I was doing my due diligence on properties I was buying was I always called the police department. I usually found one of the patrolmen, I like the night patrolman. I call the night patrolman and ask them what they know about that area that the property's in. And then my last question to them is, if you had a daughter, would you allow her to live in this area? And that would tell me whether I'm going to move forward or not. And I do that before I go walking the property or looking at it, because I'm not going to waste an airfare flying into some place where a policeman's not going to let his daughter live. That's just one of my, that I'm out.
yeah.
Good point, Peggy. Yep.
Yeah. Well, you know how men are about their daughters, they protect them. So it's good to know. So anything else from anyone?
Yeah, I just want to give Peggy a plug for bringing Jason in and identifying talent as always. But Jason is part of a dynamic duo. They know the landscape very well. And like Angel, I mean, she knows all the, I don't want to say bad actors, but the people I'm always, investors, accredited investors, if they're not educated, they can, I don't want to say fall for a slick presentation that might be sexy on the outside, but the numbers are baked somehow on the inside. And they might be legit, but they're still not 100% putting the investor first. And I am pretty sure that Jason can really, figure out what the basics are and play detective and make sure that the investors are first in anything that they're hired to do. And we would hope more people that are inexperienced in doing syndications would be able to, seek him out and put their trust in him instead of, because the numbers that put the investors first, I'm preaching to the choir here, are beat any glossy, slick presentation any day of the week. And those things always need to be scrutinized. So credit to you both.
Well, thank you, Jace. That was just so wonderful of you to say and acknowledge Jason. And Jason, we were thrilled with your presentation, and we hope you will come back again.
Yeah, thank you for having me. I did want to say, I've seen some deals where the numbers look good, everything was verified, but what happened was the operators didn't follow their business plan. And so when you don't follow your business plan, the numbers don't mean anything. If they followed it, it could have been a really good deal, but I have seen that firsthand.
Well, how do you know whether they're following it or not? What do you do as an investor?
We've that was a fairly complicated thing, and we started realizing about 6 months in that they weren't doing what they said they were going to be doing. And so we ended up talking to a lawyer. They ended up selling it soon after that, and the lawyer's like, just wait till you get your money back, and then we'll go pursue it. Otherwise they'll just hold it hostage, and you don't want that. I know some of you people on here know who I'm talking about, just because y'all have dealt with Angel, and she's willing to tell the story. But I'm just saying, hey, the numbers should have worked. Everything looked good, and you still can get into bad groups. So
Yes, well, the almost only reason things fail is because of the syndicator. So it's really important to do your due diligence and then follow up and make sure that they've got a plan in place and that they're actually following the plan. So I've actually not had that in place before, but I was thinking that's something that's really important to ask for. I want to see your 3-year plan of exactly what you're going to do over those next 3 years.
Yep.
Ah, Jana.
Jason.
Yeah.
I think this is an interesting topic. How do you know that Peggy's question, how do you know? And I've given this some thought, and I think as an investor, and I've had some deals, I'm in, passive investor in a deal that's kind of flatlining, and it is that execution. And I have to dig out the original deck and look at what they promised and then look at what they did, and then you can see it. And so I think something as simple as an investor scorecard would be helpful, where the investors can say, what did they say they were going to do, and did they do it? And the other thing is you need access to the team to ask them to hold their feet to their fire. And, in mine, I said, hey, your expense ratio is way out of whack. What are you going to do about it? Oh, we've got it under control. And, and it just got worse and worse and worse. And it's one of those deals that I'm not sure are going to survive. So I think it's important for investors to, we say that we're passive investors, but I don't think you should be entirely passive.
No, you shouldn't be. So
Good thought. Patricia.
Yeah, how do we get a hold of you?
You get a hold
through
of
Peggy.
me and I will connect you.
All right,
We'll be happy to send you the information.
thanks.
I think we all ought to sign him up to be our second eye. Yes, Marcy. You're muted. Yes, thank you.
No. You brought up taking a look at the bank statement, just like you don't know what's going on if you only see the yearly statements as opposed to the monthly statements. Same thing with the bank statements. You might be able to see one big deposit and you don't know where that came from, whether that was borrowing or whatever. And you get a good idea of how steady the income is coming in. You just get an awfully good, better idea of what the business is really doing when you look at their bank statement along with all the other things that you talked about. So, and thank you for giving us all those 7 and the bonus information.
You're welcome.
Great. It's been great. Anything else, anyone? Well, thank you very much for being here. Jason will be back at some time soon, and I hope you have a fantastic week, everyone. See you next week.
Thanks, everybody.